Could there be a hidden downside to that shiny new credit limit increase that everyone seems to overlook? Let's find out. Welcome. Every day, I break down personal finance questions asked on Stack Exchange, highlight the community's best answers, and sprinkle in some actionable takeaways. If you're into learning a little more about money each day, make sure to subscribe to the channel. Now let's dig into today's question. Today we're exploring a common question. Is there a downside to an increased credit limit? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So in summary, a person got a letter from their bank saying their credit card limit is going up because they are one of the bank's best customers. It's the second time this has happened. At first, it seemed like good news, but now they're wondering if there's a catch. They're curious about why the bank is really doing this, and if there might be any hidden risks other than the usual warning about not racking up too much debt. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. One user points out that credit card companies profit from merchant fees on each purchase. They also earn from high interest on unpaid balances and make more money when people carry debt. Additionally, missed payments lead to fees and loss of promotional deals, boosting their profits. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Here's another answer that was shared in the Stack Exchange thread. Like before, I'm going to scroll through it quickly, so feel free to pause the video if you want to read it yourself. Otherwise, I'll highlight the main points of this answer in just a few seconds. One response points out that while increasing available credit might initially complicate getting large loans due to credit checks, a higher credit limit can show financial stability. Over time, keeping credit utilization low can enhance creditworthiness by demonstrating responsible management. Here's one last answer from original post on Stack Exchange. I'll quickly scroll through the answer so you can read it. Feel free to pause the video if you need more time. And just like before, I'll be highlighting the main points of this answer for you in just a few seconds. One response points out that high credit limits can hinder loan approvals since they're seen as potential debt. Reducing available credit might boost loan chances, as credit card companies use high limits to keep customers from turning to competitors for loans. Alright, now that we've seen what the community had to say, here's our take on this question. Higher credit limits can actually boost your credit score if you don't max them out, showing you're managing credit well. However, lenders might see this available credit as possible future debt, affecting loan approvals. Plus, the temptation to spend more is real, so sticking to a budget is key. So in this video, we've discussed how credit card companies profit from merchant fees, interest, and late fees, especially when spending increases. Higher credit limits can boost credit scores by lowering credit utilization if managed wisely. However, they might also affect loan applications and lead to overspending, so sticking to a budget is key. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.